Good morning, ladies and gentlemen. Dobré ráno, dámy a páni. On behalf of the three institutions that organize this event, the Ministry of Finance of the Slovak Republic, the National Bank of Slovakia and Bruegel, I would like to welcome you to the National Bank. My name is Rainer Martin. I'm Executive Director for Research, Statistics and Economic Education, and I have the great pleasure and honor to guide you through this event this morning. Let me welcome, in particular, the Minister of Finance of the Slovak Republic, Mr. Ladislav Kamenický. The Deputy Governor of the National Bank of Slovakia, Mr. Luboš Kekety. Members of the Board of the National Bank of Slovakia and members of the Executive Council, ambassadors, and of course our esteemed speakers, in particular Rebecca Christie from Bruegel, simply because Bruegel is also one of the co-organizers of this event. Of course, also a warm welcome to the colleagues from the National Bank and from the Ministry of Finance, and to all other participants here in the room and also online, as this event will be live streamed. So we have two important speakers that are not yet here, but they will arrive in the course of the morning. The first one is the Governor of the National Bank of Slovakia, Mr. Peter Kazimír, and the second one is Mr. Nicholas Veron from Bruegel, who, as we speak, is apparently in a car en route between Dubrovnik and Bratislava. But we are very confident that he will arrive on time. But it does require a little change in the program, and the change is basically that we swap the panel session and the third keynote speech. So he will be the second to last speaker of today's event. So the topic of today's event is Savings and Investment Union and Closing the Investment Gap, Slovak and European Perspective. Now, Savings and Investment Union is obviously a key project to address many of the challenges that the European Union and Slovakia, as all other countries, are currently facing. And the key word here is, of course, competitiveness, with all its facets, but also the green transition and the increase in defense expenditures. It's a very complex project, and it has many national and European features to it. So let us dive straight into the topic with the first keynote speech, looking at these issues primarily from a Slovak perspective. And the first keynote speaker is Mr. Ladislav Kamenický, the Minister of Finance of the Slovak Republic. He is holding this position since 2023, but it's the second time that he is holding this position. And he looks back at a long experience of economically focused policy making in the Slovak Republic. So, Mr. Kamenický, the floor is yours.
Thank you. So I will be a little longer today. Be waiting for the colleagues. So, dear colleagues, dear Excellencies, really distinguished guests of National Bank, representatives, private sector guests, ladies and gentlemen, colleagues. Good morning and a warm welcome to this important conference co-organized by the National Bank of Slovakia and the Ministry of Finance, with the esteemed participation of the Bruegel Institute that marks its 20th anniversary this year. Congratulations. I would like to deeply appreciate the extensive work that Bruegel has done over the 20 years of its existence. We are meeting with the representatives and fellows at the ECOFIN meetings, and I have to say that the discussions are always inspirational. Analytical work of Bruegel in many areas, including the capital markets, financial governance, among others, is of great added value. It is just recently that I have had a chance to discuss in depth with the director of Bruegel, Mr. Zettelmeier, in Luxembourg, and I very much value the fruitful discussion we had. Ministry of Finance as well as the National Bank of Slovakia are proud members of Bruegel. Today we are gathered in the premises of the National Bank of Slovakia, so my special thanks to the National Bank of Slovakia for making this event possible and for the hard work and effort in its organization. On today's topic of discussion, moves in financial markets are alpha and omega for every Minister of Finance. It is a part of my job to act very sensitively with the financial markets, especially today, given the huge consolidation efforts. My every step is being closely monitored by them. It is a unique experience to serve as the Ministry of Finance in these uncertain geopolitical times. The global economy stands at a pivotal moment. From navigating the lingering effects of inflationary pressures to addressing the challenges we face relating, among others, to competitiveness or the trade wars. In this regard, the Savings and Investment Union is one of the critical examples of the effective EU common reaction in order to make the EU stronger and more competitive. Europe faces a significant investment gap, estimated at 800 billion euro annually, according to Bruegel's 2024 report. For Slovakia, a small export-driven Eurozone economy, this gap presents both a challenge and an opportunity. Our SMEs and tech-driven industries, particularly in automotive and IT, require robust financing to scale innovation and remain competitive. However, the fragmented capital markets limit access to private investment. A challenge also echoed the Bruegel's analysis. For Slovakia, this means enabling our startups and mid-sized firms to access EU-wide funding pool, reducing reliance on traditional bank financing. We see merits in Bruegel's recommendations for simplified listing rules to attract investment while ensuring financial stability. By extending and expanding access to non-banking financing, the Saving and Investment Union can unleash a more dynamic, innovation-driven economy across Europe. In this regard, I would like to highlight the concrete example of Slovakia's recent step in this area, our Retail Government Bonds Initiative, launched in spring 2025. This pioneering program invites citizens to invest in the state's bonds with a minimum of €1,000, with proceeds exempt from the personal income tax and primary market fees. Available through 5 major banks and traded on the Bratislava Stock Exchange, these bonds open to EU citizens over 18, including foreign investors, mark a significant step toward deepening our capital markets. With a total issuance cap of €500 million, this initiative serves 2 critical goals: diversifying state budget financing and boosting financial literacy among Slovakia. By involving the public directly in the economic future, we are not only raising capital, but also empowering citizens to engage with financial markets confidently. I would also like to highlight the importance of regional cooperation. I support the initiative to deepen regional collaboration in development of capital markets across Central and Southeastern Europe. Financial literacy is a cornerstone in enhancing the trust in capital markets. Slovakia is taking significant steps in this area, embedding financial education in school curricula and launching public programs to equip citizens with the tools to manage finances, save responsibly, and invest wisely. Slovakia has the highest ambition in digital financial services with successful fintech innovations like mobile payments and online banking, reducing barriers and enhancing financial inclusion. However, as Bruegel's work notes, digitalization brings challenges that must be addressed to maintain trust. Slovakia is committed to robust regulations that protects consumers while fostering innovation on one hand, and on the other hand, to support measures that will not create additional burden and barriers for SMEs in their activities. The Slovak capital market, by not yet ideal, is evolving rapidly. The collective investment sector, including mutual and pension funds, is growing dynamically. This aligns with emphasis on sustainable finance, and we are working to enhance liquidity on the Bratislava Stocks Exchange to attract more investors. To conclude, I would like to reaffirm Slovakia's commitment to this transformative agenda. The Savings and Investment Union is a historic opportunity to strengthen Europe's economic resilience, foster competitiveness, and secure a prosperous future. Since the national efforts alone seems insufficient, only a unified European approach can bring the investment gap and unlock our collective potential. Lastly, the Savings and Investment Union cannot be achieved without the completion of the banking union. Together with Bruegel, the National Bank of Slovakia, and all of you, we can turn this vision into reality. Let us seize the moment to build up a Europe that is innovative, inclusive, and forward-looking. Thank you for your attention, and I look forward not only to our discussion today, but also to our future discussions based on further valuable and impactful inputs and analysis prepared by colleagues in Bruegel. Thank you very much.
Thank you very much, Minister, for getting us off to a great start of the discussions and for mentioning also many aspects that I think are very important. So there's not just a European and national perspective, there's also the regional perspective, and also for mentioning financial education and the completion of the banking union. Let me now turn to the second keynote speech, and the second keynote speaker is Mr. John Berrigan. John, can you hear us, John?
I can. I hope you can hear me.
Yes, perfect. Thank you. Thank you very much. So Mr. John Berrigan is Director General for Financial Stability, Financial Services and Capital Markets Union at the European Commission. So he's been in various senior management positions in the European Commission since 2010, and he is, of course, very much and very closely involved in all the financial market initiatives since then. So he will give us a public sector view from the Brussels institutions on Savings and Investment Union. John, the floor is yours.
Thank you very much. And first of all, ladies and gentlemen, it's a great pleasure for me to join you this morning at this, what I think is a very important conference about the Savings and Investment Union from an EU and a Slovak perspective. Unfortunately, I can't join you in Bratislava. I can only join you from here in Brussels because of other commitments. I should also apologize to you in advance because of my poor quality of voice. I have some kind of allergy which is simply won't go away despite all my best efforts. So I will do my best to keep my voice through my remarks, and hopefully we will make it through. In my remarks, I will discuss the Commission's proposed strategy to make progress in building the Savings and Investment Union. And while I describe it as a Commission strategy, I should be clear that we see it that the Member States have a very important role to play in building the Savings and Investment Union, not only in passing EU-level legislative reforms, but in taking important reform action at national level. And this joint responsibility between the EU and the national level is a very key feature of the Savings and Investment Union strategy. Now, at the EU level, the Savings and Investment Union has been made a key priority for the mandate of this Commission. It was highlighted as such in the political guidelines set out by President von der Leyen last year. And earlier this year, the Savings and Investment Union was identified as a key enabler of EU efforts to boost economic competitiveness in the EU Competitiveness Compass. Then on the 19th of March, the Commission adopted the communication on the Savings and Investment Union. And this communication laid out, as I said, what the Commission sees as its strategy for making progress in delivering the Savings and Investment Union in this mandate. And I'll return to that in more detail in a couple of minutes. But the focus of the strategy will be on supporting household wealth creation by increasing the returns on savings of EU citizens while widening the financing opportunities for businesses. In this way, the Savings and Investment Union will connect savings to the most productive investment with a clear link to competitiveness in the EU economy. Now, this debate on Savings and Investment Union, as mentioned by the Minister, is taking place in a wider context in which the geopolitical and economic environment in which the EU operates is evolving in ways that are rapid, uncertain, and quite profound. Important choices lie ahead amid what are opportunities but also great challenges of a reshaped globalization, climate change, and technological development. And meeting these policy challenges effectively will require a much more ambitious approach to economic development in the EU. Our international partners are already adapting to the new geoeconomic realities, and the EU must also adapt. And the Savings and Investment Union is just one of several major economic reforms that the EU must make if it is in fact to respond to those challenges of a new geopolitical and geoeconomic order. Now, against this background, there is a sense of urgency, I think, at the political level for developing the Savings and Investment Union, and this is widely shared. The European Council has called for rapid progress, and the Eurogroup, including the member states not using the euro, has developed its own action plan for the Savings and Investment Union. But it is, of course, time not just to have words, but also to have actions. And as confirmed by the feedback we received from all the stakeholders, building the Savings and Investment Union will require actions that are a combination of top-down, so that's EU level, and bottom-up, national level, but also a mixture of actions that are legislative, but also non-legislative. And that now brings me to the communication and the way the Commission sees the Savings and Investment Union strategy. We have essentially 4 blocks, which I'll go through in order. On the savings side, the Commission is considering initiatives in areas like financial literacy, saving and investment accounts, and the promotion of supplementary pensions. We believe that increasing the role of supplementary pensions in particular can be a game changer in delivering higher returns to savers and by increasing participation in capital markets. Now, in this regard, we recognise that changes to the EU-level legislative frameworks can provide only part of the solution. We don't really have competence in many of these areas like pensions or financial literacy, nor do we have competence in areas like tax incentives necessary to encourage savers into capital markets. So we will also need the member states to set appropriate incentives for participation at the national level. On the investment side, the big topic is how to promote larger pools of capital to support investments in the European Union economy and lower financing costs for Europe businesses. Policy measures at both EU and national levels will also be needed to promote investment in equity in general and venture capital and growth capital in particular. Action is needed to significantly increase the funding opportunities for all EU businesses from the startup phase right through to more mature companies. The mobilization of private funds, notably from institutional investors, can also be supported by an efficient use of public funds and initiatives. The third block we look at, of course, is market fragmentation and how we can remove sources of fragmentation in EU capital markets, allowing the possibility of market-driven consolidation and greater efficiency. In particular, remaining barriers prevent the EU trading and post-trading infrastructures from exploiting the benefits of a truly frictionless single market. Fragmentation and unnecessary regulatory burdens also represent a drag on the competitiveness of the EU fund management sector. Of course, all of these cross-border barriers also prevent EU citizens from benefiting from investment opportunities and lower fund fees. So that is the third block we want to look at. And then the last block we want to look at, which is always the most controversial for some reason, is more efficient supervision. And we believe that this should be an objective of the Savings and Investment Union. It will ensure that all financial market operators receive the same supervisory treatment, irrespective of their location across the Union. The principle of mutual recognition is a pillar of the single market, and in an ideal world, it would be enough. But it might not be enough to ensure a proper integration of capital markets. With a few exceptions, today, EU capital markets are supervised at national level. And despite having a single rule book, national authorities often apply the rules quite differently. Such divergence discourages cross-border activities by increasing compliance costs for companies, and it limits the choice for people and businesses. Such divergence can also create conditions for supervisory arbitrage, which can undermine confidence among market participants and erode trust in the market. So the Commission, conscious of the sensitivity of this issue, we are still reflecting on ways to further harmonise supervision. But just to be clear, harmonised supervision in capital markets doesn't always imply a single supervisor. In principle, it can also be achieved through convergence of national supervisory practices. But clearly, the EU level would be required to play a more important role. So these are the four blocks we have: savings, building pools of capital, improving market efficiency, and enhancing supervision. And we will come forward with proposals, both legislative and non-legislative, in all of these areas by the end of this year, which is rather faster than we would normally do so, but we recognize the urgency of the situation. Now, if I'm turning to, from the EU perspective to the more Slovak perspective, what I would say is that from our visits around the EU in preparing the Savings and Investment Union communication, we did a tour of all of the member states. We're aware that some stakeholders, notably in smaller member states, such as Slovakia, have some doubts about the relevance of the integrated capital market to them. Is this all of interest to them? And I would answer these doubts by reference to both theory and practice. Economic theory has long supported the economic benefits of financial integration, with the benefits actually flowing disproportionately to smaller economies with less developed financial sectors. And this non-linearity in the benefits of financial integration, which was very prominent before the great financial crisis, is almost completely forgotten now in the current debate, but it is very important. Secondly, in practice, I would simply cite the experience of my own home country, Ireland. Ireland has moved from being the poorest member state of the Union when it joined in 1973 to being among the most developed today. This transformation in economic performance was not achieved based on the national savings balance or the national financial sector alone. It was achieved by integrating with the EU economy and by tapping international pools of finance. So this is, in my opinion, a model. Of course, the correct policies are required, but to break the financial constraint, you really have to integrate into the wider pools of international finance. Now, I can see already that Slovakia has benefited from integration into this EU single market and access to open capital markets. It's been a net recipient of foreign capital, especially of FDI from other EU 27 member states, resulting in a net international investment position equivalent to about minus 50% of GDP. Being visible and accessible to EU investors will therefore be important for Slovakia cooperations. Indeed, the creation of the European Single Access Point may be one of the more important deliverables of the past CMU action plans for Slovakia. Changes in growth drivers will make capital allocation via capital markets and equity funding more important, also in Slovakia. The expansion of the services economy, technological progress, and smaller firms growing into mature and more international players are likely to become more important growth-defined drivers. And in that context, just as for the EU as a whole, capital market funding will be an essential complement to traditional bank lending, as highlighted by the Minister just a few minutes ago. So efforts to increase the still low participation of retail investors on capital markets in Slovakia, and not just in Slovakia, but across the Union. But this can benefit from the exchange of best practices with other member states and comparable initiatives at EU level under the Savings and Investment Union umbrella. This could involve developing a national strategy to enhance financial literacy for retail investors, and in particular SMEs, for example, tailored IPO education for SMEs. It could also involve the creation of simple investment accounts or investment products, or fostering supplementary pension for the developing the existing second and third pillars of the Slovak pension system. In this case, I can't resist mentioning that the first pan-European pension product, one unfortunately of very few such products that has been offered, was offered by Finax, a Slovak provider. So these are just a few of the ways in which Slovakia can use the EU Savings and Investment Union to boost its own domestic levels of savings while further integrating into the wider and more diverse financial system of the EU. So I repeat what I said earlier, the Savings Investment Union is not just some project of EU relevance. We believe it is a project of relevance for all member states at the national level. Let me just conclude then by again thanking you for the opportunity to share with you these remarks on the savings investment strategy. From my personal experience, and I have been around the game quite a while, I am under no illusion that building a savings investment union involving an integrated EU banking sector and capital market is an easy proposition. However, just as in 2012, when the context of the great financial crisis demanded progress in the banking union, the current context, I believe, demands progress in the savings and investment union. The EU finds itself in a global order that is increasingly characterized by regional power blocks. If the EU is to be relevant in such a global order, it must become more integrated and act more collectively and less like a combination of 27 now relatively small member states. Advancing the Savings and Investment Union is just one part of a much wider effort to preserve the EU's relevance going forward. Will not be easy to achieve, but as I think you'll understand, the stakes are high. I'll stop here and thank you very much for your attention. Thank you.
Well, thank you very much, John, for your insights and for reminding us also on a few very important aspects, such as the benefits that financial integration has, in particular for small countries, of reminding us of the major geopolitical context, and also of the sense of urgency that is underlying this project and that hopefully will increase the chances for its successful completion. So thank you very much indeed, and have a good day in Brussels. Thank you for joining us. Right, ladies and gentlemen, we are now coming to the panel discussion, and as you see, we have a rather large panel prepared for you. This is because we would like to combine various perspectives here. We would like to have the perspective from the banking sector in Slovakia, from the non-bank sector in Slovakia, and also a European perspective. So, this panel will be chaired by Vladimir Dvoracek. He is member of the board of Národná banka Slovenska, and in his portfolio is also financial stability and capital markets. Let me now introduce also the other members of the panel. I'll introduce them one by one and then ask them to take a seat. Right, Rebecca, you're eager to join, so...
Rebecca is first.
Rebecca is a senior fellow from Bruegel. She has a very long career also in journalism, which is interesting, and probably helps to explain why many of her publications are eminently easy to understand, which is really a very, very good feature. Right, then I would like to introduce Mr. Peter Krutil. Mr. Krutil. Mr. Krutil is the chair of board of directors and the chief executive officer of Slovenska Sporitelna. Let me then introduce Mr. Bernhard Henhappel. Mr. Henhappel is member of the board of directors and chief risk officer at Tatra Banka. Let me now turn to Daniel Gaspar. Mr. Gaspar is managing partner at Crowdberry, so we're moving here now to the non-bank part of the financial sector. Let me now introduce Mr. Miroslav Singer. Mr. Singer is member of the Executive Committee of Generali Central and Eastern European Holding, and he is, very importantly, also former governor of the Czech National Bank between 2010 and 16. And last, certainly not least, Mr. Martin Wiedemann. Mr. Wiedemann is CEO of the Central Securities Depository of the Slovak Republic since 2013. And with this, I hand over to the moderator of the panel.
Thank you very much, Rainer. Excellencies, ladies and gentlemen, I'm very glad that I can share this panel full of distinguished panelists, 6 panelists. I expect very interesting debates, but let me first to have some particular comments on this topic. As everybody very well know that Savings and Investment Union could be Europe's push to turn its patchwork of capital markets into one single, powerful, growing engine. So this is a very nice idea, and we now know that there are 3 main aims. The first one is regarding households. To draw households from deposits to diversified investments. This is the first very important goal. Second is to unblock cross-border flows to make them easier. And the third one is to give companies possibility of alternative financing, mainly through capital markets, mainly equity and bond options. But coming back to Slovakia, let's go to discuss this issue also from perspective of small EU member state. Slovakia is a good example why it matters. Let me just refresh our memories. Let's go to have a short overlook to Slovak history of Slovak capital markets. This history is not very long, just around 35 years, but this road was very bumpy. First, in 90s, there were several fraud schemes, and the trust of investors was hurt. We can say that this story was about market failures and missed opportunities. The result was thin trading, equities were marginal, and savings parked in banks. Only in recent years, mainly after the COVID crisis, we see gradual increase in assets invested in capital markets, mainly funds, equity and real estate funds. So, what is the question now? Question to panelists. Would it be possible that Slovak companies will raise money across the EU as easily as at home? By simplifying fund registration, by reducing issuance costs? And second, could be the Savings and Investment Union a game changer also for retail clients to channel domestic savings into productive investments? And last but not least, we have to see this issue also from European level. If this is the way, how to increase competitiveness of the European Union in global level. So, ladies and gentlemen, now we are starting our, I hope, very interesting debate. And my first question is to Peter Kurtil. Peter, how do you see the role of banks evolving within the framework of the CIU, particularly in supporting capital market access for retail investors?
Yeah, I'm surprised by this question. As you can see, it's not prepared. Okay. As Vlado was presenting in his introduction speech, the history of capital market, I was part of this first fraud schemes. This story in sometimes in 91 or 92, I worked in different bank at that time, and we prepared first prospectus. This was prospectus for Slovnaft. I don't know if you remember. This was first share introduced on stock exchange. At that time, we dream about capital market in Slovakia. That we dream that we will connect together with Czech colleagues. That it will be Czechoslovak capital market, and then happens few things which totally change the direction of capital market, and which I see as a big problem at the moment. We have a structural problem in savings of our people in Slovakia, our clients, by the end of the day, and I think a colleague of mine will talk about this, and the role of the bank. I think, if I may say, we are trying, and we as Erste Group, we are trying to little bit build the financial, if I may say, financial inclusion, that people are using different financial products. It depends on their life timeline, or in which life period they are. I think it's very unfortunate that 80% of our savings of our people is in banks, which is making us, let's say, very easy target for all regulators, because we are combining all of these financial assets, and it's very bad. It's very bad also for our clients. Therefore, we are fully supporting, and we are doing even the practical steps that we are trying to build the capital markets, not only equity part but also bonds market, and I think we will discuss later on this issue. We are very active in pension funds, which I think it's very important part of the building the capital market union, if I may say, to have the long money for investments. And last but not least is the question how in this region we will build the culture of venture capital and private equity fund, which is source of structural changes and investments in research and development. I think there is a lot of issues, but we have to understand we have limited resources. We have our savings rate is, I don't know, 4 times lower compared with Western countries. And we have a lot of obstacles. And I think we will talk later on. This is, for beginning, enough, because I see around 6 people and a lot of things. And this is my view, let's say, for beginning.
Thank you, Peter. So we very well know that Slovakia is banking economy. That's why also our second panelist is also from the bank, Bernhard Henhappel, CRO in Tatra Banka. Bernhard, what do you mean? Would the bank support the development of the capital market and SME financing if portion of these savings of retail clients were redirected into capital market investments?
Yeah, so definitely we are supporting the creation of this saving and investment union. Yes, of course, as was already mentioned, a lot of money of Slovak citizens are lying on bank accounts, on saving accounts, on current accounts, in total like 47 billion euro. But we see this as a sign of trust for the Slovak banking system, and we see this as a reflection that the households are looking for a safe place to put their money and their conservative approach. Yeah? But on the other side, the money is not only lying on saving accounts and current accounts. Already 28% of the money in Slovakia is in investments, and this is not a bad number. Yeah? So here we, I think, are in the average of the European Union with this 28%, and you would come even to a higher percentage when you are adding also insurance, etc. So I would say Slovak households are not adverse to investing, and I'm very happy to say that when we look into the Tatra Banka portfolio, and we are here the network bank for Raiffeisen Bank International in Slovakia, yeah, we can see that our clients have already 36% in investments. And this is making us happy. Yeah? Of course, the clients are focusing on these low-risk investments. We can see this also in investment funds on the low-risk side. But I think it's important to have financial education, to increase the financial literature, and then this enables also to go into more risky investments. And I think the banks can here be really a very good counterpart and enabler, and make from our savers investors, and from our investors even investors into the European future, because I believe that Europe needs a lot of investments now. Yeah? We need to foster innovation, we need to introduce the ESG agenda and drive it forward. Defense spending was now written everywhere. So money is needed for Europe to grow, and I think Slovak investor can play an important part of it. And we like to be part of the Slovak investment.
Thank you, Bernard. Now, not only to have contributions from banking side, we have now here representatives from non-banking sphere. Daniel Gaspar is managing partner of crowdfunding company Crowdberry. Daniel, I wonder, because one of the goals of the Savings and Investment Union is to improve access to venture capital funding for startups and scale-ups. What impact do you expect to smaller EU markets like Slovakia?
Yeah, thank you for having me. I'm totally humbled, to be honest, to have such a kind of exposure in this very prominent conference, because to be frank, we are not a crowdfunding platform at the end. That's one of the pillars that we have in our private markets multi-asset manager, what we are. We have 3 investment funds which specialize in startups, real estate, specialty real estate, but also impact investments. And the crowd investing platform is basically a tool to mobilize private capital into SMEs, into companies that actually are addressing what Draghi and Letta was mentioning in the reports, and that's productivity and competitiveness. Because honestly, I don't want to be too negative, but in Slovakia, there are only 350 companies that are bigger than 50 million euros turnover and are owned by Slovakians. That is really like a very, very sad number. It's basically a kind of small, medium, or medium city in Germany. with the number of companies owned by local entrepreneurs. And this is what we are trying to change. It's a kind of unnatural that the largest growth capital provider, and was mentioned by the very important speaker before this panel, is the growth capital that enables the companies to grow. To answer your question, venture capital, and totally, I think also the discussion will go into public markets, IPO, etc. But without genuine and deep private markets, there are no IPOs, there are no public markets, because the companies need to reach a certain size. And with the venture capital, I'll conclude with a question. Why are teachers from Ontario or widows from Scotland owning our companies and not our pensioners? This is what I leave to the panel to discuss in the further steps.
Thank you, Daniel. So now, on my left side is Ms. Rebecca Christie, Senior Fellow from Bruegel. So now we have some information from European perspective. And my first question, Rebecca, is, as a Senior Fellow at Bruegel, how do you see the role of public policy in creating a favorable environment for retail investors, particularly in smaller economies like Slovakia within the framework of the CIU?
Thank you so much for the invitation. Thank you, all of you, for coming. Capital Markets Union is now part of this Savings and Investment Union framework. And one of the reasons they changed the name was to make it seem more accessible to retail investors and less abstract. 10 years ago, when we started the Capital Markets Union project, it started with sort of a survey of everything that was creating and contributing to this fragmentation that we see across the EU. In the beginning, there were a number of technical improvements made to the markets with listings, with a consolidated tape, single access points, some of these things on the wholesale side to make the plumbing work a little better, but they didn't make massive changes to the investing environment, as we know. So now we're at a moment where Europe needs massive investment, and there's a renewed interest in creating a bigger and more fluid market to try and get that money moving around. I would like to draw attention to something that Mr. Kutza said, which is that it is not just banks anymore. It is very much, and it's not just equities. We're looking at bond markets, we're looking at other types of transactions, and innovative ways to get more money moving around to more places, to SMEs, as we just heard, and other things like that. So how do we do that? We've done the small technical things that were easy to do first. We are not yet ready collectively to do any sort of harmonization on things that are really tied into the broader economy, like taxes, like insolvency law, and to some extent pensions and mortgages. These are all things that are too integrated to solve with one piece of markets legislation. So that leaves us a couple of areas where we can make some progress. One of them is supervision. You'll hear about that in a bit from my colleague Nicolas Ferrand, who is almost here. And one of them is retail. Retail investment is something that European citizens mostly are not comfortable with. A notable exception is Sweden, and people often talk about Sweden's great tax system and structure to encourage people to invest in voluntary pensions. What they leave out of that shorthand is that Sweden has 100 years of ordinary citizens being very comfortable investing in shares through their cooperatives and other things like that. They're used to owning a piece of a company. They're used to understanding that the value goes up and down but increases over time, and they're used to being part of that. So what can happen at the EU level? I have long advocated, and I did this in my work at the ECB last year, for a label, a European way of sorting what funds are most appropriate for retail investors. And if I were in charge of designing the policy, I would design something where the EU would essentially set some standards, say low fees, diversification, tracks the broader market, some things that are appropriate for regular people to invest in, and then say, instead of choosing from the 50,000 UCITS, that's a type of investment fund, UCITS funds that are out there, you can choose from this smaller list that have been that have done some pre-diligence for you. Right now, we have something where every time you go, typically through your bank, to invest in equities, you have to answer a long list of suitability questions. Do you understand this? Are you comfortable with that? Do you know what you're getting? And the banks essentially charge you a high fee for the privilege of taking this questionnaire, which then cuts into the returns that you make from your actual investment. Over time, if we can upstream some of these requirements, or as Sean Berrigan was saying, perhaps streamline or get rid of some of them altogether, this will reduce the administrative costs for the service providers and make it more attractive for retail investors to get involved. The last thing I'll say on this first round is that certainly in Belgium, where I live, you hear a lot of people saying, oh, if you want people to invest, you need to make it interesting for them. You need to give them a tax break. And what I would say is, while tax breaks have a purpose and are best suited to be really suited to the specific tax structure they're in, more broadly, the reason it's interesting, the reason you do it, is so you make money. And so when you retire, you have more money than you did when you started. And we need to create a situation where people involved can become wealthier over time. That is what will make retail investing really attractive.
Thank you very much, Rebecca. And now, Miroslav Singer. Miroslav Singer from Generali Group, but also from your previous capacity and from your current capacity, Mirku. How do you perceive the potential of the CIU to unlock new investment opportunities for institutional investors like Generali, especially in terms of integrating more cross-border capital into long-term infrastructure or security projects?
Well, first to say, in a nutshell, insurance industry serves three social values. Yeah? First, it provides liquidity for those who do not have, because of disaster, any assets to collateralize and needs to continue the business or need to continue their life. Yeah? Second, it manages risks. And the third one, it provides long-term investments in less liquid projects. Yeah? In this respect, we are more, I would say, constrained by supervision and regulation than by non-existence of savings union. Yeah, simple as that. That's the first thing. So this is what saving and investment union can give us, is to give us deeper markets in some products and to create more productive, meaning higher return opportunities due to competition on European markets. That's so in this respect we would welcome it, because that would give us broader markets to work with. Yeah? And I should do two warnings perhaps also. First, we are not constrained, at least in terms of Generali Group, we definitely do not feel too constrained investing in security or defense or whatever else industries. It's not our problem. And also, I've heard here a lot about sort of energizing Europeans with all due respect to saving and investment union project. The common European, even if we proceed with the dazzling speed of having proposal by the end of the year, as I've heard, meaning we will have something workable next year or the year after the next one, the common EU citizen will see the fruits of this effort in 5 to 10 years. Yeah, this is not a political situation changing project, despite, and I'm slightly worried about the fact that it's framed like this in EU Commission discussions, in general communication of EU structures towards its voters. No, this is simply not going to work. Or to put it in a different way, Vlado, did a Slovak citizen ask you in last 5 years about European products as something? No. We are talking technical thing that is going to bring more productivity, more competitiveness in a long run, but in a short run, it is not going to solve any political problem of Europe.
Thank you, Mirku. Good to hear from you. And the last panelist here is Martin Wiedermann. Martin Wiedermann is for many years CEO of our local Center Securities Depository. Martin, what do you expect? Is the savings and investment union an opportunity or the threat, and why?
Of course it is opportunity, and of course it is a threat, but the question is where is the threat and where is the opportunity?
Provocative question, of course.
The opportunities is to easier the regulation, to streamline the regulation, to create more flexibility. The opportunity is into creating the same level play field for companies in this industry, because we have their subjects which are providing similar services than the CSDs, but they are not under CSDR regulation, so this is not creating the same level. And of course the opportunity is, it looks like the same regulation for all the CSDs and for all the countries creates the play field for harmonization. But actually, what we have learned, one size doesn't fit to all. It means it is not necessary to force countries and CSDs when there is no demand for certain services to implement the solutions. It is costly, ineffective, and then the infrastructure is too expensive and doesn't work properly. So this is something what we should talk about and find a differentiation and find a way how to differentiate and apply the regulation properly. What is the threat? I think time and complexity of the process, because what we are receiving a lot of questionnaires. We are asking to give more proofs and evidences to this and that, but what we should prove? That what is obvious? It was already named in the letter from Neuer and Letta. We already named the problems and we know what to do it. So the thread is that, as Elvis Presley sings, a little bit more action, a little bit less conversation, please.
Very nice. Thank you. Okay, so we are after the first round, and I want to ask you if there are any questions from the audience. If not, we will continue with the second round of questions, maybe later or in the end. So, Peter, your bank, everybody know, is
not my bank. I'm working in this bank.
Okay.
This is different bank when CEO is owning partially the bank.
Okay. This bank, which you are working with now, is a part of European Group Erste. So my second question will be a little bit broader. And I want to ask you if, in your view, why there is such low activity of investment banks, not only locally, but also in the EU? Under which circumstances would banks support the capital markets by becoming market makers?
Yeah. Vlado told me that we are fine with time, but with this question, I think this will be not the case, because if answer the part of this question, it will take me a longer time. But I will try only to mention a few bullet points, and I will try in my second part use also a little bit more data. It was already mentioned we have approximately 55 billion euros in savings plus 25. I think on corporate, which is 80 billion euros, yes. Then you have pension funds. We are at the level 120, 130 billion euros, maybe together also with some with life insurance part of the business. And let's imagine, which is approximately 8,000 euros you have per capita. Imagine how you can manage portfolio. The average saver in Slovakia, if there is 8,000 euro, how many investment funds you can advise to buy? This is This is one part of the problem, and I have to say the maybe bigger problem, which is valid for the whole Europe. There is limited opportunity to invest, and this is the reason why almost 2/3 of pension fund savings, if I may say so, or future pensions, are invested in US, and only 1/3 is invested in Europe. And out of this, majority of asset classes invested in Europe are more fixed incomes and classical assets, not equities, which then has problem on the structural things. We have, let's say, fast-growing European companies moving to US, because in US they can build a much better structure of balance sheet, investing to the equity. And now answer how banks can solve this problem, I think it's illusion. We cannot solve this problem. We would like to be part of the solution, and exactly as Elvis Presley said, we like more action than talking about it. And action is also, and tax, and you mentioned the tax holidays. But unfortunately, people are asking for tax holiday not because this is not the reason to invest in equities, but there are different asset classes having these tax holidays, and to keep these products competitive against some asset classes, maybe more traditional, this is what investors are looking at, and I would say it will be really good if you have, let's say, the harmonization of taxation at all asset classes. This is the problem. It's not a problem. And last but not least, and you're right, the banks are sometimes charging quite high fees to the investors. I agree with you, but I think competition here will solve this problem, and I think Revolut is a good answer. And you can see, and Revolut is pushing really the fees down. I don't know if regulator is happy to hear it, but this is the case. And we have to somehow adjust our policy. And now I will a little bit focus only on Slovakia through data. You have to take, if I look only on Visegrad countries, Slovakia is only country having loan-to-deposit ratio higher 100% compared to others. I think Czech Republic is 65–70%. Poland, Hungary, everywhere you have more savings compared to the loans, which I am asking myself, how much we can invest, or what's the potential market for future investing in capital market, having such let's say such structure, and I think I will finish all with this. Why it is so? Because of negative rates, because we are part of the European Union, and what we need is from my point of view, let's say the new structure of all tools which are creating long-term prosperity of the companies which are looking for the money, and you have your clients who can invest in this money. And unfortunately, we are slicing this problem. And last problem is, let's imagine I was trying to buy in one IPO in Czech Republic 3 months ago. It took me as a paperwork 3 days to participate. And then we finish with my advisor in Czech Republic that I will buy first day after the IPO on secondary market because it's much easier. And now we can here discuss about a lot of nice things, and why the big banks are not in the Europe. Maybe this is the answer, because it's not easy to make money in the Europe, but then you have answer that European banks have 60–70% NII dependency on the income, and the US bank, they are below 50%, which you as a banking supervision, you will for sure be more happy if our diversification of income is higher. In other words, what I am saying, it's a very complex problem, and it's not easy to now say 2–3 steps. But where I will start with unification of regulation and make regulation more easygoing, which will be not easy, because I fully agree with with my colleague from Czech Republic. It's politically, this is nothing what will help to win elections. And this is the problem.
Yes, it is. Thank you very much, Peter. You finished? Yes. Or you can.
I understand. No, I will. I finish.
Maybe in a third round you can add more. Bernhard Henhappel is also from Cross-Border Bank. And my question is focused on this. Because everybody know that there are some challenges and regulatory barriers when you face these barriers, when you're facilitating cross-border investments. And this is also one of the aims, of goals of the Savings and Investment Union, to help to address this. What do you mean about it?
You know, I think there are three main barriers, yeah. And this is, for me, there are different investor protection rules. There are huge complexity in taxation, and we heard it already, it was mentioned by Mr. Krutil, for example, and we have also this limited financial literacy and trust, yeah. And so it's important that the people understand in what they are investing, that they can trust the providers, and of course, the closer this provider is to you, in your own country, you know the counterparts, you know the banks, you know Crowdberry, etc. So you can trust. When this is now somebody coming from Spain, you are not so accustomed to it. So when we go whole Europe, we have to find a way how can the European population really trust, independently from which country this provider is coming, independently if you as investor are living in this country, because we see these big differences. People like to invest in their own country, but when they have to cross borders, it's becoming more difficult. Taxation is a nightmare. It's a nightmare, withholding tax, everything. The only persons that are really benefiting from it are the tax advisors, yeah? Because, you know, when they are then happy because they can send you big bills in order to guide you through the different landscape of European taxation.
And also governments.
Yeah.
Yeah. And, but we do not even have to look at gross Europe taxation and how different it is. Even in the own country, like in Slovakia, we are differently taxing ETFs and mutual funds. Yeah? So a harmonization here would also be highly beneficial and would lead to a more level playing field. Yeah? So we don't have to go far, we can also stay a bit closer. And yeah, investor protection rules, again, difficult enough to understand them in one country, almost impossible to understand them throughout whole Europe. So there's a lot of work in front of us before we can make it happen.
Thank you very much. Very interesting answer, because this problem to achieve this goal is very broad issues, and issues which are out of the scope sometimes, like taxation. Unfortunately, Minister of Finance is not here, and also financial. And also question of financial literacy. This is something very broad problem and very interesting topic. Okay, and now to switch to non-banking participants. Daniel, from your perspective, what policy or regulatory challenges under this CIU would most effectively stimulate cross-border venture capital flows within the European Union?
Yeah, this is a very broad question.
Very
so needing the whole hour for that. It's very tough to say, but I believe the start has to be made at home. There is the Sweden example being mentioned, and these guys published a very interesting paper on developing the capital markets in Sweden in the last decades. And what they say there, they did just 4 main pillars, what helped to increase the depth of the capital markets, not even the public ones, but also the private ones. And I agree with you, the Swedes, it's a 10 million population economy, plus minus. So it's like Czech Republic. I believe Czechs also invested in their own companies 100 years ago, like Petrov or the piano maker or the Orion. I think those guys were already emitting shares back then. But what happened in Sweden in the first step was that they have started to work on the framework so the money can flow. It's the discussion about a depository, maybe the depository for the whole European Union. Because, for instance, if I would like to have an investor in a Slovak company from Czech Republic, it's a nightmare. It's basically a technical nightmare because the guy has to come, whether through our bank or through the market participant, through the depository of Czech Republic to the depository of Slovak Republic. It's very costly, very complicated. So Swedes actually simplified this framework of capital markets, private and public. The second, what they did, they motivated institutions like pension funds I mentioned before, the teachers and the widows, but also the insurance companies, but also family offices to invest in local economy. Because, I mean, you mentioned how to bring the private guys to invest in capital markets, but I'm not really sure if the goal is to make them all invest in ETFs. Because, the public capital markets have a couple of reasons to exist. One of them is governance, for instance. It doesn't really work with ETFs. The other one is price discovery. Doesn't really work with ETF. And the other one is also the liquidity. But if you look at also current capital markets moves, the liquidity is basically not there that much because people are sitting in ETFs. And the advisors are saying, please don't sell, just wait, because it's 8% per year, 100 years in the future, which the Japanese investors might not agree with. Anyway, the Swedes, back to the Swedes. The third pillar, what they did, they created an account. It's basically like a savings account with a special tax regime again. For 5 years, there's a kind of exam period, and they home-based it. So what they say, 70% out of the money of that account has to be invested in Sweden. Swedish companies, small companies, startups, scale-ups, but also capital markets. And the rest can go as they want. Similar thing is happening in Europe with Spain and France. I mean, they have this coalition of willing, not only in defense, but also in creating pan-European savings products. And I think the fourth one was to drive the ability to go IPO, because the home bias was already created. So you have a lot of retail investors not having trouble to join the IPOs and then going to secondary market. So I think we probably, the SIU, and you ask about the measures, there's so many measures being discussed, I don't even know where to start, but we have to start at home, I believe, mobilize the local capital so we can see the examples of companies that are successful and they actually want to have capital, because this is one of the problems. I would definitely unleash the banks, because I agree that we are overbanked currently. I think in EU it's like 5 times more assets of banks to GDP than in US, because US banks are doing what they should do, and that's providing the infrastructure for money to flow it, and also to advise. So I would really unleash them and let them invest in equity again, because after 2008, we introduced Basel III with a lot of complicated rules in order to allocate the bank's capital in local investment. There is also discussion on securitization. Everyone is like, okay, this caused the financial crisis. But it's not true. It's basically just redistributing the risk into the, for instance, insurance companies, longer-term assets. So this is what has to be actually improved again, although Slovakia is a very small market for securitization, but sometimes some innovation can happen. And last but not least, and I hate it, it's taxation, definitely. I mean, there's no reason to motivate capital to flow to US, especially in Slovakia with 1 year exempt, not enabling the local companies or even European companies to get the capital for a better taxation or equalized taxation treatment.
Thank you, Daniel. First, Rebecca, then you, because we need more reactions on this. Please, Rebecca, then Peter.
So first of all, I couldn't ask for a better setup to the sorts of things that I like to talk about. So thank you for starting these conversations. I fully agree that intermediation is a central question of how to get retail investors more involved in capital markets. And the question is what? We probably don't want retail investors en masse moving to day trading and becoming market makers themselves. I do not think that regular retail investors should be the main sources of price discovery. Most of the time, they trade at a lag to the center of the market. They don't have the same information. I think putting retail investors in that role would be a disservice to them and the markets. On the other hand, over-intermediation, only being able to reach the market through very complicated and heavily regulated investment funds probably doesn't work. By the time you go through all the disclosures, the bank isn't making any money, the investor isn't making any money, so that's not great. So where's our sweet spot? ETFs play a role. One could make the case that in a properly designed market, the ETF aggregates, and then the ETF itself does the market making and the price discovery. So rather than me personally needing to do it, the ETFs are, but if they're truly trackers, if they're really passive funds, you don't get that. But there are still a number of actively managed or relatively actively managed funds that do something like that. The PEP, the Pan-European Personal Pension product. This is something that does exist in Slovakia, which is amazing because it only exists in 4 or 5 countries, although there's ads to have more. The main reason to me why this product did not get off the ground is because it's trying to be all things to all people. It's trying to be low cost, so there's a cap. It's trying to require maximum investor protection, so then you have to provide all these services for a fee that doesn't cover the cost of providing them. And it's supposed to allow portability of the tax break from member state to member state. What that means is if you have one of these, you have to open a sub-account. So technically you have one European account, but in real life you have to open little accounts if you move. It's not efficient. And for the EU to move forward, we need to unbundle these things. We need to unbundle the tax break from the type of account that you have it in, whether it's tax advantage pension or just a straight up account, from the thing that goes in the account. And by addressing each of these separately and looking at best practices across borders, I would say that is how we can make progress on this. And that leaves room for many market players to try and form solutions. Because at the end of the day, if it doesn't trade, it's not a market. So we have to have secondary markets. We have to have people moving things around so that things can have prices on them. And the way to do that is to, again, unbundle and look at ways of creating good channels.
Thank you, Rebecca. I prepared a different question, but it comes later. Peter.
I have only one remark to ETFs, which sometimes we and regulators are trying to cover a lot of risk through us as intermediators, but I'm afraid that the quite high risk we have on the market in ETFs, and I tell you why. Because I don't know if you know, but 30 to 40% depends on the day. Trades with shares is closed in last 20 minutes on stock exchange, and this is because of ETFs, because they have to keep this. And if this really will go in wrong direction, then we have inside of big systematic risk. We will be very well advised clients. Everyone will have excellent MiFID agreement with clients, but unfortunately, market will move in wrong direction. And I think the things is very basic. People are investing in US. Where is for us, the dream market? They are investing because they are making money, not because they like equities. They like make money. And I think in Europe, people are not investing because they have a lot of good examples where people can make money on equities, and this is it. And my technical remark on ETF is only be careful with ETFs. And by the way, ETFs in Slovakia, they have zero tax. Investment funds, so we are paying tax even after 5 years having investment fund, which is saying our tax structure is saying, let's invest in ETF because it's more efficient for you.
Yeah. Thank you, Peter. So, Rebecca, now my origin question was, how could the CIU influence the relationship between fiscal policy and capital market development in the EU, particularly in context of fostering more sustainable and resilient financial ecosystems across different member states? difficult question?
This is a good question, and there's a lot of ways to answer it. So I am going to look at sustainable in the sense of debt sustainability for member states, and not sustainable in the sense of green finance. I think that is a related but separate question about how do you create an investment climate for the green transition. When you're looking at the relationship between Savings and Investment Union and fiscal policy, you're really looking at how can the markets take over some of this investment so that the public purse doesn't have to. And that's where making money is important. If people can make money, if they are not as exposed to a loss of income when they retire because they have their own investments, that eases the strain on public pensions. And so that's a very good reason all by itself to help these things develop, not to replace basic public pensions, but to complement them so that people can have higher qualities of life. The other thing I would say is that when you have a thriving market economy, it raises productivity because the good firms can have more money, they can scale up, and you get more economic growth. When you get more economic growth, you get better government revenues, lots of things get better. So markets and government spending can create a virtuous circle and can work together, and I think that should be the goal.
Thank you. So, Mirko, now the question is, as a manager of leading insurer, do you think that CIU could stimulate more participation of insurance industry in the EU capital markets? What specific regulatory changes would help facilitate this?
Well, first, insurance industry in EU invests almost 10 trillions of euros. Yeah. So I believe we have got experience in investing. That's first thing. On issues here, I should also mention we have quite an experience with retail market. We have quite an experience even with retail investment as a generally here in Central and Eastern Europe, and of course in Italy and some of the major markets, not all of them actually. But talking about more interest in investing, we are effectively talking supervisory frameworks, yeah. And here what I found necessary to stress, it is a conceptual problem of supervision that it treats insurances like banks. It effectively treats them like something which may need cash on demand if people are losing their trust in a particular institution, which is nonsense. Yeah? Like insurance industry that's why Buffett started around insurance industry. Insurance industry, if it is insurance and not a big hedge fund framed like insurance in case of AIG, if it is an insurance, it cannot have a cash flow problem. Simple as that. I mean, like people are paying premium to insurances, and insurances, by the way, are highly cash flow counter-cyclical, meaning in terms of good times, people go more to life. Life sellers have a premium which is a cash flow drain. In bad times, actually, this is not going to happen, and insurance is creating cash. Yeah? Like simple as that. But at the same time, the risk for the insurance industry is measured effectively mark on market day to day. There is no recognition that insurance has quite a leeway when it wants to liquidate its projects, yeah, when it needs to sell. Yeah, I'm not only in generally supervisory boards. I'm also a member of supervisory board of Moneta Bank, which is something like number 5-6 bank in Czech Republic for years. This is a conceptual different. These are conceptually different animals, which risks is measured in a same concept of mark-to-market, effectively day-to-day operations. Yeah? And this is, I think, so no matter what we do with solvency, no matter whether we allow more leeway and whatever, this is the crucial problem of allowing insurance to go to back. And let me return to what I said in my first it's one of its three major social function, which is the last one, investing in long-term illiquid projects. And this was always a role of insurance. I'm sitting in an insurance that's based on two institutions that started around 1827, 1826, which is generally Česká pojišťovna. This is there is no wonder that old insurances have a collection of arts. Yeah? Old insurances have buildings, but they are now less able to do so because after the last financial crisis, they are conceptually treated as something close to the bank, which they are not. Yeah? So on a general way, this is the problem. Yeah? And let me mention one thing on a personal level. There was long discussion about retail and products in Europe. First, we should start thinking about whether we cannot at least make the tax rules in a way that would allow AI to take part of the burden of a retail investor in preparing the things for his local tax office is this way. I must say this particular country I absolutely love because it added another dimension of transaction tax there, super, thanks a lot. But fine, this is, in my opinion, more achievable goal than some harmonization. At least allow for tax preparation, because as a retail investor, I'm calculating my bloody dividend and yield taxes every year for my tax advisor. This is the way of me, but it's not going to be done by a normal retail investor. This is the major burden, I believe. And talking about, you talked about IPOs, but try to invest from Prague in a saving account of a branch of a Slovak bank, trying to get euro savings to a saving account, and you find out that you need to go to the notary. Yeah? You find out that you need to. Come on, I mean, like, we are talking competition on European level, but this is simply no-go. I mean, like, it's.
That's what
so revolution would start on saving accounts. That's what I'm trying to say, not on IPOs. Yeah.
Very good example. Thank you, Mirko. Now we are going to speak about infrastructure a little bit, because reform of market infrastructure is also an important part of this project. Martin, what do you think? What role do you see central depositories playing in supporting greater cross-border investment flows under the EU, especially in streamlining post-trading processes?
Well, the greatest contribution of CSDs is harmonization of its processes. Thereby, their processes would become more predictable for foreign investors. But let me help with some numbers. Actually, as regards the settlement services, our depository migrated to T2S already in 2017. And we consider our settlement to be fully aligned with the European practices. From the next Monday, when the European collateral management system is to be launched, we will also support the unified processing of collateral of the Euro system. And regarding to the links and to the efficiency, the total number of European members have links worldwide. It's over 300 links what the European CSDs have worldwide. The number of links in Europe is more than 250. And the 11 CSDs have more than 15 links. So international CSDs have extensive global coverage within the EU, allowing for links to every European country and beyond. Building and maintaining these links is costly. And it was already said, it is influenced by legal and tax fragmentation. We do not support measures mandating the construction of new interconnections without further market demand. Any such measures would increase infrastructure cost and would not solve fragmentation of liquidity problems on its own. I think we do have enough connection. We do have the tool. We have perfect highway. What is T2S? But there is no traffic on the highway. Actually, we do need more IPOs. We do need more activity on secondary market. Is what said. And exactly, it is very difficult for Czech or Slovak investors to go to IPO in Portugal, not even in Slovakia. How do we, so we need to reestablish the whole environment. We need to help banks working more in investment banking segment, to promote the IPOs, to give the information to the investors. And we should not prohibit investors to invest.
Thank you. Reaction?
I was just like talking about banks. Yeah. Again, let's face it straight. Yeah. With the level of consumer protection driven on national level, by the way, more than half of it is driven on national level, but there is also, of course, EIOPA, EBA, and agencies level as well. Yeah. I strongly believe that for a bank on investing, it's better actually not to do advisory now. I mean, given the burden of that, have your own bank products or your own bank labeled products, sell them to the client as the only option over the counter, save all notification, know your customer, have you trained your counter people selling the things? This is effectively what we cost unintentionally in Europe, but I believe this is the way to go. So don't think about the role of the bank on advising. I think the current regulatory framework is such that for bank is the best thing that it can do is to sell only its own product, meaning one bond fund, one money fund, one or two equity funds, so something strategic, and do not do advising. Yeah? This is what we achieved by over-regulating Europe, and this is not going to be solved by the motto of agencies, which is simplification but not deregulation.
We have
think about that. Yeah? The simplification, but this is not going to alleviate the burden too much. I mean, like if you just check that you do not force anybody double report something, this is not a change.
More flexibility. We need to open the hands for the banks.
Mirko, I see more reactions on this topic. Daniel.
Thank you. I wouldn't necessarily agree, to be honest, because bank has a lot of clients. And I'm not talking about retail clients. I'm talking about companies. And if the companies want to grow, the bank should be able to give them advice.
No, I'm talking about retail.
Yeah, but that's not relevant. That's a different story of the whole balance sheet, a different side of the balance sheet. I mean, the bank should be able, and that's the lack of investment banks and the intermediaries that help the companies to go through the stages. You have the startup. What does a startup need? Human capital and financial capital. If there is a bank that then can at least steer him to who to go to, fine. Startup grows to mid-cap or scale-up. Well, then also a bank could help them to find alternative funding options or partners to get to another stage. Then there are family companies. We have a huge pipeline only in Slovakia, reaching now 100 million euros. We never had it before. People now see that there are possibilities to grow, increase productivity by companies in Czech Republic, and who should advise them? What's the best instrument for them? And then ultimately at the very top there is the IPO for some. I personally believe that for most, not really, because the price discovery is not just simply there. I have a small portfolio of German companies of 200 million, approximately 250 million market cap. There is no price discovery. No one is investing in them. All the advisors from Deutsche or from UBS will tell you, unless you reach 2 billion plus market cap equity, don't even go to stock exchange, because otherwise you will be mispriced. You will not be able to get new funds into your company for growth. So I believe there needs to be a combination. So sorry for such a longer intrusion, but I believe you're right. There needs to be intermediaries that help the company to go to capital sources that they require. And the banks are natural ones.
Thank you, Daniel. Maybe now there is space also for questions from audience. My second attempt. Is there anybody want to ask something? No. So we will continue, and maybe in the end, my third question to Peter Kruchil is, we know that institution you are working for operates as the seed starter, an incubator for startups. Do you believe that the CIU could enhance the opportunities and motivation of startups going into EU markets?
I believe this is nothing which will make money for my management contract term. This is clear. This is something what is really for the long-term future. It's maybe not even for our investors. It's more that we are keeping in touch with companies in early stage. And there are two reasons from my point of view. One reason, because you need this fresh blood on the market, and you have to support these companies because there are already few which are, let's say, in more higher stage of their, let's say, the life cycle, and they are still our clients. Which for me, it's not only that we are helping to the country, to the economy, but we are helping to us to acquire new clients. And if you take in consideration the average, let's say, lifetime of the companies is shortening every year in these days. The old companies are simply leaving the market, and you have to be more active. And as it is with human capital, you have to be also very active by acquiring the new clients. And you can acquire new clients only if you understand what they are doing. And you have to totally change also your way of thinking, which is always not easy to discuss, especially with risk management. And it's not easy to keep let's say, keep in line with all these regulations. I think we can discuss. This is another issue for discussion. But we strongly believe we are investing. Unfortunately, with 5 million euros in Slovakia, you can be the largest corporate VC fund in the country. We invested in private equity together with colleagues in Tatra Banka, and simply we are trying to be on the market in all stages of the companies, because we are trying to understand the market, because this is the only way how you can serve this market. This is my strong opinion, and hopefully we will do in the way that we will even make money in long-term future, but for sure not in short-term future. This is the reason. But also there is the small market, and it's a really small one, that you can show your expertise to your investors community. And typically those investors, these are affluent clients, which is something where we are looking for. We are targeting this market, and this is like helping us to be successful also on the side of the let's say investor side. And last but not least, look, we are here also. This year is 200 years is Erste or Slovenská spořitelňa is in Slovakia. We went through different life cycles, but what is clear, we are committed to the Slovakia. We are not investing our money to other countries. We are not investing in Czech Republic, in Romania, in Hungary. We are committed to the Slovakia, and I am always saying we can be only as successful as is this country successful. This is our mission. It's not easy to keep profitability, let's say, comparable with our competitors in Visegrad countries, at least, if not looking in much broader market. And I hope once the country will have a reasonable size of the VC market, we will have the private companies, we will have a lot of family-owned companies, as you already mentioned. And here, I think next step for us is to combine this private money with European money and to put together these two types of financing in one financing, and which can lead to the high impact on the economy. And as I said, we are committed to this country, and we have to do everything what can help to move this country in next level. And as we know, we need a lot of structural changes in this country, and there is not so many. Let's say we need all money used for this restructuring, as other countries in our region. In other words, from short-term point of view, it's simple. Our commitment to nothing economical, but I strongly believe in long-term will lead also to the economical benefits of the bank, hopefully. But this is for next generation of bankers.
Thank you, Peter. This is very comprehensive contribution to our discussion. And we have some time, so I'd like to switch to different topic now, to securitization, because securitization was mentioned here, but securitization is one of the proposals of the CIU to support securitization activities in the EU. What do you think, Bernhard? Do you see any opportunity in this area?
Yeah, I think securitization is a very important tool, and our major shareholder, Raiffeisenbank International, is using this securitization tool quite actively. So over the last years, RBI has done several securitization transactions, and some of them were also done with the help of Tatra Banka, because of course, as also Slovenska Sporitelna, we as Tatra Banka, we are a Slovak-based bank, fully focused on the Slovak market, only doing business in Slovakia, but we have the big advantage that we have a lot of large corporate clients, SME clients, etc. So we have quite a granularity of the portfolio. And in these securitization transactions, it's often about granularity of the portfolio, and to be able to put a lot of clients into one securitization transaction. So while Raiffeisenbank International has, as they're serving only the biggest clients in Austria and in Central and Eastern Europe, Western Europe, they have only a few clients in these pools, but the more granularity then comes from the country. And so we could participate, and this is very, very beneficial because it's frees capital. And when securitizations are freeing capital, this capital can be then again used for new loans, for loans to clients, to help clients grow. We can do investments into more early stage also, and this is helpful. So we are fully supporting all these initiatives that would again boost the securitizations. But maybe one remark, I think also banks have to be careful not to do too many securitizations, because when you are doing them, you always have to be aware that after some years they are expiring and then they need to be replaced. Yeah? So you should not generate too much capital just via securitizations and only use it as one small part of your, let's say, capital strategy.
Thank you. Thank you, Bernhard. My last question to Daniel is about startups, surprisingly. So what are the main barriers for startups and scale-ups going public? Do you believe that CIU is addressing those barriers?
Well, in my opinion, first of all, startups and scale-ups should not go public in that stage of their development. Mm-hmm. They definitely have to go public when they reach a critical mass. That's why also it was mentioned by the Draghi report that 30% of the unicorns are basically leaving Europe for the US. So I think it was mentioned already a couple of times in these discussions. The access to capital is key in order to startups and scale-ups to reach the critical mass and not leave the EU. I mean, the Revolut, mentioned a couple of times here, is now considering Nasdaq versus London Stock Exchange for their own IPO. Would be a shame, even in Slovakia, 400,000 clients, that's a lot for such an app. Yeah. Oh, Klarna is another example. So, I mean, Mario Draghi quoted 750 or 800 billion to be invested annually. That's 4% of the GDP of the EU. EU has like a 20 billion, 20 trillion, sorry, GDP. For Slovakia, if you would just swap it, it's like 5 billion additional investments per year into, transition, energy, digitalization, which is the productivity part of the whole game, and obviously innovation. I believe the biggest hurdle for any successful companies, like mentioned Spotify, Klarna, and the UK-based Revolut, established by Russians living in France, that's the beauty of Europe, is basically the deep pockets of the capital here already mentioned. And that those are pension funds, insurance companies. They should be incentivized to move the patient capital in companies that they reach the critical mass, that they're not that risky anymore, like in the very early stages as Slovenská sporiteľňa is supporting the local seed and post-seed capital ecosystem, which we are not that able anymore because under the European crowd investing license, we rather move to a lot more stable companies in order to not be able to creating the broad portfolio and startups. So, I mean, there should be a kind of wrap-up of this discussion because we are talking about a lot of measures and platforms within Europe via the SIU, but the SIU is just a subset of competitiveness and productivity of European companies. It's just a necessity, it's not the goal. It's just something which has to happen. There's no discussion about it. We screwed it like 10 years ago. We discussed the Capital Markets Union, which very limited parts only happened. But now, I mean, if you won't be able to make it as a prerequisite, I believe we will be lost by Chinese and US guys. That's pretty sure. Look at the electric cars. I mean, BYD is making cars for 70,000 euros. European cars in the same category, same quality, cost like 30 plus. So the future is not going to be very bright for Europe unless we move, because we don't have time to discuss.
Thank you, Daniel. Rebecca, I mentioned in my opening remarks importance to increase competitiveness, EU competitiveness on a global stage. Given your expertise in economic research and EU issues, how do you assess the potential impact of the CIU to increase EU competitiveness on a global stage?
So the good news is Europe has a lot of savings that can be put to work and a lot of consumers who can both invest and take advantage of the services and products that these companies offer. So there's a lot of economic potential here. What we need is more throughput. We need more things moving around. And I'd like to touch on a couple of the other things that people said. On the question of what types of financial products should banks offer, I would make the case that banks could serve in more of a brokerage role. So it's not quite the Wild West of you opening an account on your phone, but also maybe it doesn't have to be this extremely, extremely heavy-handed and expensive to provide service. Like there ought to be a middle ground, and a bank ought to be able to compete with other service providers to do that. On the question of insurance companies, one thing that makes Europe different from the United States is that the boundary between what is an insurance firm and what is a pension company is somewhat blurry, because many pension contracts are structured as insurance with payouts. And also, insurance companies do need to be liquid in the sense that as we have climate change or natural disasters or other things like that, they do need to be able to make payouts. So there are some concerns there. We have coming out in just a couple weeks from Bruegel a really interesting report on what cross-border investments insurance companies and pension funds across the EU are making, and I would very much encourage you to look at that. They look at home bias, EU bias, and foreign investment. It's a really interesting data set, and they're going to make the data set public. On securitization, I would say that as long as securitization in Europe is seen as capital optimization on a bank balance sheet and not as creating a capital market instrument that trades off the balance sheet, it's not going to have a big impact. If you're bundling something but not even selling it the first time, let alone creating something that can be sold in the secondary market in the way of US, for example, mortgage-backed securities or other asset-backed securities. People always love to say, oh, you need Fannie Mae and Freddie Mac, but there are plenty of non-GSE securitized products that trade, that move. And that is what Europe needs to be competitive. It needs the volumes. We've heard several people talking about scale. When the EU has the confidence to see the functioning of this market as another piece of infrastructure, like electricity, like other types of services, like manufacturing, that I think is when Capital Markets Union will have its full ability to support the European economy.
Thank you very much, Rebecca. Coming back to insurance, Mirko, I know that you have very strict rules how to invest technical reserves in the insurance company. But anyway, how do you see the potential for the CIU to create new opportunities for insurers to diversify their investment portfolios, particularly in the content of supporting SMEs and long-term infrastructure projects?
Well, not only SMEs, the governmental development funds we see and so on, which relates quite a bit to what Rebecca has said. First, securitization would be elevation in some products, especially development funds and similar things. It's completely, we are now, for example, developing the old care programs in Czech Republic as an investment for insurance companies. And this is, hopefully, we will get to the scale in which it will be able to securitize at some point. But at the same time, and I want to be clearly understood, of course we need to be liquid, but we do not need to be liquid within one day as a bank. It is about measuring the risk over a longer time period, because insurance is very unlikely to be, as I know, I'm chairing a risk committee of a bank, of a supervisory board, as we need to take care about the situation in which overnight people may decide to withdraw the money from a bank. That's a completely different situation with whatever you can see in the insurance industry. Yeah? That's what I was tracking. So the measuring of risk should be adjusted to the reality of insurance industry for things like solvency, risk weights, and in general. So that's one, and that would immediately allow bigger investments in what Vlado you mentioned. But let me add one thing on pension and insurance. I believe, and again here I completely agree with you, Rebecca. I believe it's also about labeling. We are big supporters of French, Spanish labeling proposal. But again, if we go for everything there, we will achieve nothing. This is an experience with common European products so far. By the way, this is also experience with the fair bank account of Slovakia, which I believe about 5 people have in the whole country. The problem is, if you think it as a pension product, you should allow for having illiquid part of portfolio. Perhaps you can even think about supporting illiquidity, meaning in terms of not being on demand by tax advantages. But still, I'm a bit skeptical on tax breaks, as I work a little bit as a problem solver over 11 countries of Central and Eastern Europe. The typical cycle with pension product tax advantage is you get a right-wing central government, it takes care about its voters, and perhaps also about intermediaries which would sell the product, produces some pension, nice upper middle class pension scheme, which lasts until the new left-wing central government comes in, needs to take care about the taxes, and its own fiscal priorities. And of course, these are not these voters of a left-center government. So the first thing that's going to be cut is a pension scheme, yeah? Pension tax advantage. Unless you achieve something like Swedes, you have it mass, or something like Romanians, you simply have too many people in second pillar and third pillar that do not trust their government to want to invest in a state pension fund. You don't have stability of these products. Yeah? Simply politically speaking, you don't have stability of these products.
Thank you, Mirko. And my last question is more technical to Martin Wiedermann. My question is, what are the main technical and regulatory barriers that currently limit cross-border registering of securities or settlement efficiency in the EU? What do you mean about it?
Well, I hope we will not end with this boring topic, but actually, for debt securities, there is no serious barriers to cross-border registration, as well the equities. Technically, there is no inherent problem with legal certainty in the current framework. The reality is that demand for cross-border insurance remains low. The question is why. But it was already named here. It is the tax differences. It is the differentiation in corporate law. So, and if the depositories should hire teams for different jurisdictions to check for the different tax procedures and different corporate laws, it became inefficient. So it is simple as it is. And what I didn't heard in the CU discussions, that we should check for the best corporate law, corporate tax law, corporate law in Europe and implement it in Europe. To find what is the best tax law, for example, I don't know, Malta, and implement it. Okay, it sounds like science fiction. It will not happen, I understand, but it needs really political courage and political will. So what we should and how we should proceed with that, if this is science fiction and will not happen, what we will do. So the answer is like to create like regional hubs like in Central and Eastern Europe, because we cannot compete with other markets to the West European countries, and we can forget about America. But if we will co-work and try to establish like the Baltics did, like the Swedish does, then we have a chance.
Thank you. Mirek?
Are you talking about tax harmonization, or are you talking about filling tax forms? Yeah, because in my experience, the major barrier for Slovak citizen, normal 10,000 euros up to few hundreds of thousands of euros, so a few hundreds of thousands of euros investor, is not the fact that he is taxed differently, but the fact that here, if you invest, you do not have to take care about your tax returns on dividends. You do not have to take care about your tax returns on interest, as opposed to whenever you invest to Sweden, or you have to fill it yourself. And if this thing could go somehow automatically, that would alleviate major burden, in my experience, major burden from investing around Europe without necessary tax harmonization. Yeah, that's what I meant when I was talking about AI, or somehow allow digitalization simply to fill the forms also for all European products. Yeah.
The similar problem is not only on retail side; it's also on corporate side.
Yeah.
You know.
Yeah, but corporate is big. Yeah, I mean, a small retail investor with 10.
Yeah, but if we are talking about efficiency of the infrastructure, and I need to, hire too many people to maintain the infrastructure, then it is not efficient.
Yeah.
And,
thank you, gentlemen. Now, because we have just 3 minutes.
Let them discuss. Yeah. That's good.
That's good discussion, but maybe this is the last call for some questions from the audience. It is also my duty to give space to some Peter Tkac, my director.
Thank you very much for the interesting discussion. I have to say, I heard some very interesting ideas that maybe we can take back to our department and discuss later. My question is to Mrs. Christie. Is it a sort of prophecy question? Where do you see the single EU market regarding the SIU achievements to be expected in 5 years? And for the Slovak market participants, I would like to ask you, where do you see Slovak capital market in 5 years? Thank you.
Would you like me to? Okay, so yes, sure. Thank you very much for the question. Thank you very much for the enthusiasm. I do think that European Union capital markets have a lot of potential if and when Europe is ready to go to the market. We require two things. We require, first of all, a mental shift that market activity is good, that the goal is not just to sell something once, the goal for it is for it to be out there being bought and sold all the time. You've heard many people in many contexts talk about volumes, volumes of VC, volumes of bonds, volumes of stocks. These volumes become more relevant as the markets move around. And that's what the US has that the EU doesn't have, but could have if we can make this mental shift. The other thing, and you will hear about this very soon in the keynote thing, is a common supervisory framework for most market activity will really help. You'll say, well, how are the rules directly tied to the activity? You're going to get a good argument on that. But I will say it will help more than you think it will, because it will get rid of so many of these tiny barriers that add up. And there's no way to do it than to do it. There's no secret third option that's going to fix that other than moving to a common system.
Thank you. Do we have any other questions? If not,
and about Slovak market.
He asked also about the Slovak participants. What's the future of Slovakia 5 years from now? But maybe you are not willing that we will answer this. And we can move to other questions.
This was okay. Second, you want to answer this?
No. I don't know, because I don't know what will happen in 12 months from now in this area. But my dream, I will share. I think it's important to have dream. It's easy. Part of the things which already Rebecca mentioned. For me, it's. My dream is that Slovakia will be in this area something like part of the Central European market. This is I think we have to really. I'm a strong believer that we can create strong position of Central Europe, not only because our two mother companies are very active in this region. This is economical reason, but also I am a strong believer that this is part of the Europe which can grow. It's growing above the average, and to keep this growth is only if we will team up together and play maybe more important role also in European Union as a region, not only as a small 5 million country.
Thank you, Peter. So now,
good answer?
Yes, very good answer. Okay. Thank you very much.
Well, may I, maybe for the last 10 seconds?
Yes.
I stay also optimistic, and I think we should take the momentum and, to help stock exchange groups in Central Europe to create a single access point. And for us, for infrastructures, there is a task to find the easy way how to operate the post-trade transactions, not to let them go through 2, 3, 4 intermediaries, and then the chain is too long. There is big risk of failure, and it's costly. So in 5 years, I think we can make it.
Thank you, Martin. So who else want to contribute to this debate? If this is not the case, let me say thank you to my very distinguished and experienced panelists, to Rebecca, to Mirek, to Martin, to Peter, to Bernhard, and also to Daniel. For me, it was very interesting, and I hope that it was very interesting also for the audience. Thank you very much.
Thank you very much, dear panelists and dear Vladimir. I think it was a fascinating discussion and a conversation that hopefully will facilitate some action going forward. I thought that was one of the nicest quotes also from this panel. So thank you very much again. Now, we're moving to the third and final keynote speech, and I'm happy, particularly happy, to welcome Mr. Nicolas Veron, who had a very difficult journey, I understand, from Dubrovnik. You have to tell me later how you actually managed to get here, but he's here, so that's fantastic. Now, Nicolas is a senior fellow at Bruegel and at the same time at the Patterson Institute for International Economics in Washington, D.C. Nicolas is actually one of the co-founders of Bruegel. I think you helped setting it up 20 years ago, so it's a great pleasure to have you here. And he's, of course, also author of numerous publications on European Union capital markets, financial developments, and also all regulatory initiatives. So, Nicolas, the floor is yours.
Thank you so much. Thanks a lot to the National Bank. I'm looking for the clicker. I was looking somewhere. I found it. It's a particular pleasure and honor for me to be here because actually not only the kind of introduction you made, but my grandfather, my father's father, was born in Nitra, so every time I come to Slovakia, I feel a sense of homecoming, even so I don't come often enough. It was a different world in 1915. I'm not even going into the details, but it's part of my story. More importantly, maybe I will say a few words, and I don't know if they can be put on the main screen, which would be helpful, about Bruegel. Thank you. Because that's actually the partnership we're celebrating today, Governor, and everybody here in the audience, I guess you have heard about it earlier today already. But Bruegel is really a partnership with European Union member states, including the United Kingdom, which has leftover rights and privileges, and central banks like this one, and also private sector companies, including some banks that are also present in Slovakia. This sense of partnership is fundamental for us. So what makes Bruegel different as a think tank is that it has this direct connection with the member states, with the finance ministries, with the central bank officials, and that anchors us in the real world. And I think you know enough about Brussels to know that it's very easy when you are in Brussels to be de-anchored from the real world of what's happening in the different countries of Europe. So the fact that we are here to celebrate our 20 years, the fact that we have this constant dialogue with Slovak officials in our research projects, not only in the kind of formal processes of how Bruegel operates, a very important formal process, which is the determination of our annual research program. This is really what makes us who we are, and I wanted to emphasize that because it's so important for us. So thank you. Thanks to all our Slovakian partners. In a way, making the night trip from Dubrovnik by car was a way to signal my commitment to this relationship, and I really mean it. As you said, I was part of creating Bruegel. This was our founding vision, the vision that a think tank in Europe would not be successful if it was a Brussels think tank. It would be successful if it was a European think tank with its main interlocutors, not just in Brussels, but in the capitals. Okay, so I'm going to talk, of course, about the savings and investment unions. I wasn't here, I couldn't make it this morning in time to hear Sean Berrigan. I will, of course, in a way, take Slovakia as a case study. The savings and investment union, and within it, the capital markets union is extremely complex. One of the reasons why it's so complex, actually there are two, you can think of it as a matrix. You have this interplay, which is familiar in European matters, between the EU level and the national level. And actually from what we heard in the panel, you can also think of supranational but infra-EU regional levels. Whether that can work or not in policy terms, I think we can discuss, but that's clearly in the minds of people, at least in this part of Europe. Certainly you have EU law and you have national law. At this point, you don't have Central European law, you have EU law, you have national law. But the other source of complexity is that capital markets are very complex. Actually, there are many segments of capital markets. And here I will talk only about public policy. I will not talk about culture. I will not talk about habits of investors, customs, legacies. I will just talk about policy as embedded in the law and as implemented by public authorities. And if you look at it that way, you have many capital markets policies. If you think of banking, for example, banking, as we heard, is more important in Europe in the big scheme of things than capital markets. The European financial system is very bank-centric. But banking supervision and regulation is basically about the banking license and what you need to make the banking license work to be sure that the bank is sound and deserves its license and act if there is a problem. In capital markets, you have dozens of different legal frameworks for different entities, for different activities, and that makes it a matter of huge complexity because every single supervisory mandate, every single regulatory field is a bit different. So, what is the Savings and Investment Union? It is just a new name for a single market in financial services, or if you will, a single financial system. And that's not a new idea. So the idea is very simple. It has been mentioned several times today. Savers will get access to more investment opportunities. Promoters of projects, particularly entrepreneurs, will get access to an expanded pool of financial resources. And then you have this critical political question, which is, do you work for the intermediation, for the financial sector that intermediates, for the local financial center, or do you work for the savers and for the project promoters? And depending on your answer to that question, and I'm entering into difficult territory here, you will get a different response. If your aim is to give Slovak entrepreneurs access to European and global investors, you will make different decisions from if your aim is to promote Bratislava as a financial center. So that's just a fact of life. Let's contemplate it. We have a policy trade-off here. If each member state prioritizes promotion of the local financial intermediaries, of the local financiers, over the promotion of the interests of entrepreneurs to access markets and the interests of savers to get returns, they will get a very different outcome from if they do the latter rather than the former. And politicians manage trade-offs all the time. Policymakers manage trade-offs all the time. There is nothing inherently problematic in that trade-off. And I would say both aims are valuable, even so I would argue for the Slovak economy and its competitiveness, getting entrepreneurs to access investors is much more important. But there is a trade-off, and it has to be recognized as such. Now, because of this trade-off, it's a difficult issue. It has been debated for ages. I mentioned a few of the historical steps. I'm not going to detail them now for lack of time. I'm just saying none of the debates we had today is very different from the debates they had, what was that, 60 years ago? At the time of the Zagreb report, which traditionally is considered the beginning of that conversation in a European integration context. I don't know if you can read the quote. This is a review of that European Commission report. At that point, it was a Commission of the European Communities. So this economist, Charles Kindleberger, reviewed it in 1967, and his summary was, I read, many of the faults in the functioning of domestic capital markets in Europe and institutional weaknesses can be overcome by their progressive integration, since the faults of functioning of national securities markets are the result principally of their narrowness and compartmentalization. This could be written today. Nothing has changed. Now, we have the context, of course. We have the geopolitical context. We have the Draghi report. And I think there is pressure to act in a way that we haven't seen. I'm a bit of a veteran of these things. I've been observing them for at least 20 years. I think my first article on capital market supervision at the EU level was 2003, so I have 22 years of traction here, and it was in French, but still, there's an English translation. And I think we have not had many moments when there was a kind of alignment of incentives for policymakers to act as we see right now. Okay, I'll go a bit more quickly with the next few slides because actually I do want to leave a little bit of space for our interaction. I came from Dubrovnik by car for that. So I'll be quick here. The EU financial system is overly bank-centric. You heard that. Capital markets complement banks. They are better for certain types of projects, especially infrastructure and information. That's why we need a capital markets union as part of savings and investments union. As Rebecca eloquently said, capital markets, it's about markets, it's about equal access and trust. This has to be supported by supervision, so you need market integrity, investor protection, efficient infrastructure. All these are policy aims. They can be instrumentalized with specific legislation, specific regulation, specific supervisory action. And very importantly, capital market supervision, even so, of course, we care about financial infrastructure and prudential matters here and systemic risk management. It's primarily about conduct of business, by which I mean in the jargon of financial supervision, it's not prudential in nature. Capital market supervision, unlike banking supervision, is not primarily about systemic risk. Why is that? Because markets absorb losses and internalize risks better than banks. In banks, you have this huge moral hazard that essentially the government has to guarantee banks one way or another. There are different ways to do that, and some are better than others. Governments don't have to bail out capital markets, except in China. I'm not going there. In our market economies, if the market tanks, people lose money, governments doesn't have to compensate the investors who lost money on equities or even on bonds, which is good news. So that means that supervision is just about maintaining those key public goods of market integrity and investor protection, because otherwise nobody trusts the market and nobody will invest, which is, to a certain extent, part of the problem we have in Europe. So, see, this is my personal reading, which is probably quite different from what Schoenbergen gave you, but not that different in the substance, just different in the taxonomy of what we're discussing when we discuss capital markets union policies. And here, indeed, I will focus on capital markets and not the rest of the savings and investment union, except at the end. So I'm not going to explain all the acronyms, they're boring, but you have, to my mind, 3 levels, from the most easy to do at the EU level to the most difficult to do at the EU level. So most difficult to do at the EU level is what I call framework conditions. We discussed them today: taxation, insolvency law, pension finance. I would add housing finance. The way the housing markets are financed are very important in their structural consequences. And of course, since we're in the Eurozone here, I will mention the possibility of fiscal union, which is something we don't have, but we have baby steps towards that, like the Next Generation EU program. These framework conditions, to me, are embedded in national social models. And I'm an EU integration guy. You can call me, part of team top-down, if you will. But I work in Brussels. I focus primarily on EU policies. I will say this. On these issues, including insolvency law, including the taxation of investments, the action is in national law, not EU law. And the reason for that is that governments will not let Brussels do that for them. Even with the 28th regime, even with the competitiveness lab, all these ideas are interesting, but at the end of the day, very little can be achieved along those lines, because these are national social models. There's a preserve of national governments in the current state of EU integration. Maybe in 50 years it will be different. I can tell you in the next 5 years it won't be different. And the reason for that, so this is, if you want to use, if some of you remember Commissioner Jonathan Hill, he had this metaphor of the low-hanging fruit. The thing at the bottom is the high-hanging fruit. It's national social models. EU legislation will not address it. EU legislation, if there is any, is not, by the way, led by DG FISMA, the DG for which Schoenbergen is the Director General. It's other DGs that deal with, for example, legal system and taxation, but essentially they don't have power to harmonize. Where you do have power to harmonize at the EU level is for capital market regulatory harmonization. So things that are, so things that financial market supervisors are paid to enforce. And here we have a lot of harmonization already. We have made considerable progress since the Segre report of 1966. We can make more progress, but we're well advanced on the way to having a body of EU law to govern capital market legislation and regulation. Where we have, so that's a low-hanging fruit in a way, and a lot of it has already been done. Then you have the mid-hanging fruit, and that's supervision. Rebecca, thank you for giving me a teaser on that. The supervisory framework is also, it's DG FISMA, it can be harmonized, Article 114 for the nerds. At this point, we have a bizarre hybrid of EU supervision at ESMA, the European Securities and Markets Authority, and national supervisors. What maybe is less commonly understood is that national capital market supervisors are very diverse. They're very different from one another. So Slovakia, you can see, is on the last line, is one of those 6 countries in the EU. By the way, in the EU, you know the joke. There are no small or large countries. There are only small countries and countries that haven't realized how small they are. So Slovakia is, I think Paul-Henri Spaak was the first to be attributed that quip. And of course, he was Belgian. So Slovakia is one of 6 countries now. It was the first one, I think, where the central bank is in charge of capital market supervision. But it's very diverse. You have countries like, Croatia, where I was yesterday, where you have an agency that does banking supervision and capital market supervision. And then you have another agency that does insurance supervision. No, it's a country. That's Luxembourg, sorry. Croatia does insurance and capital markets, and the National Bank does banking supervision. In Luxembourg, it's the opposite. Anyway, very diverse. So we have this jumble of, different authorities, and nobody understands how it works, frankly. So that's basically, if you think of capital markets union policies, is regulatory harmonization, more of that, but we already done a lot. National reform of the framework conditions, that's a matter for the Slovak government and parliament. And then you have something where the EU could do more, which is supervisory integration. So I will argue that this is where the effort has to be. We have learned, I'm basically repeating what I just said, capital markets regulatory harmonization is feasible. Supervisory integration is politically hard, but it is feasible because we have seen it in other areas like banking supervision with a single supervisory mechanism, anti-money laundering supervision with the anti-money laundering authority in Frankfurt, which will be up and running very soon, and also some limited supervisory mandates of ESMA. By the way, I have to disclose here that I'm an independent non-executive director of a trade repository. If you don't know what it is, that's not a problem. It's a very obscure piece of financial infrastructure, but it is supervised by ESMA, so I have to disclose that. It doesn't create a conflict in my view. And as I said, the national social models are for the member states, not for EU legislation. The EU can act through other means. They can, shed light on the differences, benchmark, compare, make recommendations, also make conditionality when they give money, but not through legislation. So this is basically what I would like you to remember from my presentation. Of course, a Venn diagram, that's very, trendy. You have things that are easy to do for EU legislation, but not very impactful. I would put securitization there, we can discuss. You have things that the EU legislation cannot do, but which are very impactful, like insolvency law reform. And then you have supervisory integration in the middle, where the EU can act and have impact. So how should it do that? I think actually it should go all the way. And I explained that at much more depth in a paper that will be published by Bruegel in the next few weeks. The current hybrid is not delivering. It's not ensuring, basically what is intended, which is identity of supervisory outcomes when you have harmonized regulation and legislation. That is not the case now. markets tend to cluster more geographically more than other activities, more than banking and insurance. So there are reasons to have a different design for European supervision from what you have, for example, for the single supervisory mechanism of banking supervision. And the criteria, in my view, should be three. It should incentivize integration rather than fragmentation. That's what Rebecca said when she said it should be a tool to dismantle the myriad invisible barriers you have created by the national supervision framework, not because people have bad intentions, it's just the incentives they work under. It should have something fundamental which I have called location neutrality. So basically the supervisory design should not point market participants to a particular financial center. And that's very important because you need to create that trust. In my mind, the EU will continue to have many financial centers for the foreseeable future. How many? I don't know. Maybe not 27, but at least half a dozen. And the supervisory design should be neutral in that competition. So financial centers should not compete on supervision, basically. And then you should have supervisory effectiveness. Of course, the supervision should be at least as good as the one we have now, because it would not be acceptable to introduce a reform that makes the quality of supervision deteriorate. And that's very important because it needs to be as close to the market participants as it is now. So if you have local market participants who only speak Slovak, the supervisory framework should be able to speak Slovak with them and understand Slovak law. Very important. The answer, there is an answer. It kind of is a silver bullet. It ticks all the boxes. You keep ESMA. You make it a single supervisor, full unification. You phase out the national supervisors after a long, complex period of transition. Of course, this is not a problem for the National Bank here in Slovakia because the National Bank has a lot of other things to do. There are countries, as I showed, where you have securities commission, so you have an authority that only does capital market supervision. That's more complicated in those countries, but I don't think infeasible. Again, it's a matter of a political trade-off. So that's a decision for the heads of state and government, not for the finance ministers, not for the head of the national supervisors, but for the heads of state and government, prime minister, president, depending on your country, maybe even the monarch in some places. ESMA critically would have national offices in each and every member state. That gives you this quality of supervision and proximity to the market participants. These national offices could also serve as a hub. So for example, as I mentioned, I'm affiliated as an independent director with a trade repository. You could imagine that trade repository supervision is done from for the whole of Europe. This is a single ESMA competency. National authorities now have no role in that. Currently, it's done from Paris. It could be moved to, say, I don't know, Helsinki, Valletta, your favorite national capital. And I don't even want to mention Bratislava because I think Bratislava could aim for something even more important than trade repositories. So you could have this role of hub, and this is actually quite easy to engineer. The transition would be complex, but I think that's the solution to the supervisory challenge we have. My last slide is beyond capital markets union. Lots of things to say about banking, but I understand it's not the focus of this event. Banking is part of the savings and investment union. Again, it's a vision for the entire financial sector. The Commission will publish a report in 2026, so there will be more discussion, but a bit delayed compared with the current discussion on capital markets, and especially capital market supervision. Let me end with that. The current commissioner, Maria Luisa Albuquerque, is actually quite ambitious about this, so I see a scope for a lot of debate. I don't know if there will be action. I'm recommending a course of action, of course. I'm only one among a million different contributors to that debate, but I would not be surprised if we see action in that space in the next 12 months, and therefore I think this is a very timely topic for discussion. Thank you very much for your attention, and I look forward to a little bit of interaction.
So thank you very much, Nicholas. Maybe if there are any questions, we still have a few minutes.
Don't be shy.
Please.
So as you came from Dubrovnik, we have to ask you at least one question. So listen, I mean, we are trying to create single markets in capital markets. And by doing transitory phase to a single supervisor, is this the first step that needs to be done? Exactly. And why? Thank you.
It takes 10 years. As I said, it's a very complex transition. You need an initial political decision, which needs some preparation. I would say it can be made quickly, but you still need to brief the decision makers so that they understand the trade-off, and especially this fundamental trade-off I mentioned between favoring the national intermediaries or favoring the national economy. Not the same thing. Then you need legislation to empower, to transform ESMA. It's a very different organization. So ESMA, 10 years from now, if this design is adopted, is an organization which, depending on how you see it, is 10 or 20 times larger, has most of its staff, say 2/3, outside of France, in the national capitals. This is a completely different thing. It keeps the same name, but it has nothing to do with the current ESMA, basically. Completely different governance, completely different funding, completely different mandate. So you need an initial piece of legislation to initiate that process, change the governance, authorize ESMA to open offices, that kind of things. That will take typically 2-3 years. Then you need the body of legislation that would transfer the supervisory mandates to ESMA, one by one, or maybe in bundles. But as I said, you have dozens of supervisory mandates. For each of them, you need a piece of legislation that explains how that fits the new framework. So I would say this takes you an entire legislative term, 2029 to 34, EU legislative term. And in 34, there's new European Parliament election. ESMA is empowered by, you need a little bit of time to implement the last bit of legislation. By late 35, it's up and running. Now, 10-year transition. During that transition, basically nothing happens, right? Everybody is consumed by all the complexity of the transition. So is that really what we need? Hey, this is structural reform. Structural reform takes time. It's worth the effort. We know that. We have been discussing Capital Markets Union and frankly having the same kind of discussions we had today for 11 years. Juncker started it in July 2014. If we had taken action in 2015 after, a year of debate, and we do what I recommend here, we would have it now. So maybe now is the time to start. There is no quick fix. Structural reform takes time.
Thank you very much. I think we have time for one more question. Yes, please.
Thank you for your presentation. And I have a question. That means that is a change of the strategy about ESAs, because you mentioned the centralization of ESMA. We have EBA as the bank supervisors, but only for the EUZone, and IOPA will be played separately, and we still have a lot of similarity between the sectors. And our last reform was about solving or make the more efficient institution, but now you introduce the totally different view. And I would like to hear the clarification if I understand that we will now create a separate sectoral structures.
Very excellent questions. That's a bit for the nerds, of course, but many nerds in the room, I'm sure. So the European supervisory authorities, it's a misleading name, of course, because by and large, they're not supervisory authorities, but they are called the European Supervisory Authorities, the ESAs, ESAs. There are 3 of them: ESMA, the European Banking Authority, EBA, the European Insurance and Occupational Pensions Authority, EIOPA. ESMA and EBA now in Paris after Brexit, EIOPA in Frankfurt. They were created as, 3 sisters or whatever. That was always a false symmetry. They're very different from one another. They started to diverge very early. ESMA became a direct supervisor initially of ratings agencies as soon as it was created in 2011. In 2012, the Eurozone leaders, in their wisdom, decided to start the banking union and the single supervisory mechanisms. That means that the EBA is never going to be a supervisor, never. And the EIOPA is still a bit like, what it was supposed to be at the beginning without having changed much. But ESMA and EBA have already diverged from that vision of 3 sister organizations. They've diverged a lot. In ESMA, direct supervision is actually not insignificant part of what they do. And if you look at their annual report of how they're funded, EBA almost does no direct supervision. There's a little tiny thing in crypto, and EIOPA does nothing. So, I mean, in DORA, they do something jointly. It doesn't work very well. We can discuss. So essentially, what I'm suggesting is to continue a movement of divergence and differentiation that is already well on its way. And I think it's time to take the natural conclusion, which is, a securities supervisory authority is something very different from a banking supervisory authority or an insurance supervisory authority. There is no reason they should be governed by the same legislation. I think it was a big tactical mistake in 2017 to have a reform that considered them all three at the same time. I think this is why that reform has failed, primarily. There are other reasons, but I think it's completely time to differentiate, absolutely.
Thank you very much, Nicolas, and thanks again for enduring the overnight car ride. We're very grateful for that. And
the drivers were great.
This is good to hear, and I think you made a fantastic contribution to us today. Thank you very much indeed. So, ladies and gentlemen, this brings us to the final part of this event. Closing remarks to be delivered by Mr. Kazimir, the governor of the Národná banka Slovenska. So, Peter, if you please come to the lectern. Thank you.
Good morning, ladies and gentlemen. I didn't come from Dubrovnik, I came from Paris just now, so the Europe is really great in this context. So it was a real pleasure to host you here. Belated thanks to Rainer and to Bruegel for organizing today's event. And I do hope that you are going home with more than a glimmer of confidence in this very ambitious project. Europe saves a lot of money, but too much of it leaves our continent. And our goal is to keep it here and invest it in European ideas and in our jobs. After the banking union and the capital markets union, the CEIU, so Saving and Investment Union, is the third step toward a fully fledged European financial system. I must say, this is my personal view, that Capital Markets Union was only slogan, and it was big fail. This is, just to be very honest, shameful fail, which we witnessed, unfortunately, together. So hopefully, the third one steps could be much more successful. It links savers with companies and entrepreneurs that can use the money to grow. At times, we, European economy, desperately need growth and productively impetus. CEIU can play a decisive role. To make this project work, we must finish the single market, and for that to happen, we need, it's very common sense, common rules for insolvency and accounting. It was almost impossible over the last 2 decades. We need the same standards for buying and selling securities. It was very the same also with this goal. And we also need really fewer national limits that split markets. This is also about us as supervisors. This is our homework. The CIO is led by the European Commission and governments, yet for us at the Government Council and the ECB, all this matters a lot. Bigger and deeper capital markets help our monetary policy work better and make the financial system much safer. There is also the green and innovation element, or at least could be. The green and digital transitions need huge private investment. European households save about 300 billion every year, and if we give them clear and safe ways to invest here in Europe, that money can stay with us and support these transitions. So last but not least, for CIU to succeed, we need to teach and build trust. people invest more confidently when they understand finance. That's why boosting financial literacy is a must, and that's why we central banks take financial literacy very seriously. Or with other words, as my colleague Robert Holzmann used to say, if you want to build a capital markets union, firstly we need a capitalist. To conclude, completion of European singleness is a must. And doing so will give Europe more growth, more innovation, and more strength. For that, we do need a lot of courage. We do have a vision, and just to be patient and to be able, to deliver something. So political appetite is crucial here. Thank you very much for your coming and for the whole morning which you spent together. Thank you very much.
Thank you very much, Governor, for these closing remarks. This brings us to the end of the deliberations. So only two things to say. First, words of thanks. I would like to thank again, on behalf of the three organizing institutions, all the speakers and everybody who was active today, also in the audience. I think we had a very, very interesting discussion. I would also like to thank personally Peter Palusz, who was a key member of this little working group bringing together this event, and I would like to thank the services of the NBS, protocol, IT, and everybody who was involved in making it a success. So we had lots of food for thought this morning. We also have some more concrete food for you now outside this room, so please join us for lunch. Maybe you can continue some of the discussions that we had this morning. I'd like to thank you again for your participation, wish you goodbye, and I hope to see you again soon. Thank you very much.